Imagine if I told you that with just one purchase, you could own pieces of Apple, Microsoft, Amazon, and hundreds of other companies all at once, starting with as little as the cost of a pizza. Sounds too good to be true, right? Well, that's exactly what happened to Sarah, a 23-year-old barista who was terrified of investing but managed to build a diversified portfolio worth over $15,000 in just 2 years, all by understanding one simple investment vehicle that Wall Street has been using for decades. What Sarah discovered and what I'm about to share with you today could completely change how you think about building wealth. We're talking about ETFs, or exchange-traded funds, and they might just be the most powerful tool for beginner investors that most people completely misunderstand or ignore entirely. Now, before you click away thinking this is another boring finance lecture, let me ask you something. Have you ever felt overwhelmed by the stock market? Like everyone else has some secret knowledge that you're missing? Or maybe you've heard horror stories about people losing their life savings on a single bad stock pick? If you're nodding your head right now, then this video is specifically designed for you. By the end of these next 20 minutes, you'll understand exactly how ETFs work, why they're considered the safest way to start investing, and most importantly, how you can use them to build the kind of diversified portfolio that typically only wealthy investors had access to just a few decades ago. Plus, I'll reveal the 3 biggest ETF mistakes that cost new investors thousands of dollars, and the one simple strategy that could help you avoid them completely. But first, let's address the elephant in the room. When most people think about investing, they picture day traders staring at multiple computer screens, frantically buying and selling stocks, or they think about picking the next Amazon or Tesla before it explodes. The truth is, that's not investing, that's gambling. Real investing, the kind that builds generational wealth, is actually surprisingly simple and, dare I say, boring. This is where ETFs become absolutely game-changing for regular people. Think of an ETF like a basket that holds hundreds or even thousands of different investments. Instead of trying to pick individual winners, you're buying a tiny piece of the entire basket. It's like instead of betting on one horse to win the race, you're betting on the entire racetrack to be successful. Let me break this down with a real example that'll make everything crystal clear. The most popular ETF in the world is called SPY, and it tracks something called the S&P 500. Now, the S&P 500 is basically a collection of the 500 largest companies in America. When you buy one share of SPY, you're not just buying one company, you're buying a microscopic piece of all 500 companies at once. This means when Apple has a great quarter, you benefit. When Microsoft launches a successful product, you benefit. When Amazon's stock goes up, you benefit. But here's the beautiful part. If one company has a terrible year or even goes bankrupt, it barely affects your investment because you own 499 other companies too. Now, you might be thinking, this sounds great, but it must be expensive or complicated to get started. Here's where ETFs blow traditional investing out of the water. Most ETFs have what's called an expense ratio, which is basically the annual fee for managing your investment. For the most popular ETFs, this fee is often less than 0.1% per year. That means for every $1,000 you invest, you're paying less than $1 in annual fees. Compare that to traditional mutual funds, which often charge 1 to 2% annually, and you can see why ETFs have become so popular. Over time, those fee differences can cost you tens of thousands of dollars in lost returns. But here's where things get really interesting. And this is something most financial advisors won't tell you because it doesn't make them money. You can build an incredibly robust, diversified portfolio with just 3 to 5 ETFs. That's it. No complicated strategies, no constant buying and selling, no trying to time the market. Let me paint you a picture of what this looks like in practice. Remember Sarah, the barista I mentioned at the beginning? Here's exactly what she did. She opened a basic brokerage account online, which took about 15 minutes. Then, she set up an automatic investment of $200 per month into 3 simple ETFs. The first ETF gave her exposure to large US companies. The second gave her exposure to international companies. The third gave her exposure to bonds, which are basically loans to governments and corporations that pay steady interest. That's it. 3 funds completely automated, and she never had to think about it again. Now, I know what some of you are thinking. $200 a month sounds like a lot. But here's the thing, Sarah didn't start with $200. She started with $50 a month, then gradually increased it as her income grew. The key wasn't the amount, it was the consistency and the power of compound growth. This brings us to one of the most important concepts in investing that most people completely misunderstand. It's not about timing the market, it's about time in the market. When you invest consistently over long periods, something magical happens called compound growth. Let me give you an example that'll blow your mind. If you invested just $100 per month in a basic stock market ETF for 30 years, assuming historical average returns, you'd end up with over $700,000. Your total contributions would only be $36,000, meaning the market growth accounts for over $600,000 of that total. But here's the catch, and this is crucial. This only works if you stay consistent and don't panic when the market goes down. And trust me, the market will go down. Sometimes dramatically. This is where ETFs prove their worth because they're designed to weather these storms. I know that last part sounds impossible in our instant gratification world, but it's absolutely critical. The investors who build real wealth are the ones who can ignore the daily noise and focus on the long-term trend. Now, let's address some common questions I get about ETFs. First, are ETFs safe? Well, no investment is completely safe, but ETFs are considered among the safest ways to invest in the stock market because of their built-in diversification. The biggest risk isn't that ETFs will fail, it's that you'll stop investing during a market downturn. Second, how much money do you need to start? With most brokers, you can start investing in ETFs with no minimum investment. You can literally start with $25 if that's all you have. And the important thing is to start somewhere and build the habit of consistent investing. Third, what happens if the ETF company goes out of business? This is a great question that shows you're thinking like a smart investor. ETFs are structured in a way that protects investors. The underlying stocks and bonds are held separately from the ETF company's assets. So even if the company fails, your investments are protected. Here's something that might surprise you. Some of the wealthiest investors in the world, including Warren Buffett, recommend ETFs for regular investors. Buffett has actually said that when he passes away, he's instructed his wife's trust to invest 90% of her money in a simple stock market ETF and 10% in bonds. If ETFs are good enough for one of the greatest investors of all time to recommend for his own family, they're probably good enough for the rest of us. But here's the thing that really excites me about ETFs and why I made this video. They've democratized investing in a way that was impossible just a few decades ago. Before ETFs existed, building a truly diversified portfolio required either tens of thousands of dollars or expensive mutual funds with high fees and poor performance. Today, for the price of a dinner out, you can own a piece of virtually every major company in the world. That's not just convenient, it's revolutionary. As we wrap up, I want to leave you with this thought. Investing in ETFs isn't about getting rich quick or beating the market. It's about participating in the long-term growth of human innovation and productivity. When you invest in a broad market ETF, you're betting that tomorrow will be better than today, that companies will continue to solve problems and create value, and that the global economy will continue to grow over time. History suggests this is a pretty safe bet. Despite wars, recessions, pandemics, and countless other challenges, the long-term trend of human progress has been consistently upward. ETFs allow you to capture that growth in the simplest way possible. If you found this breakdown helpful and you're ready to start your ETF investing journey, I've put together a free resource guide with specific ETF recommendations and step-by-step setup instructions. You can find the link in the description below. Remember, the best time to start investing was 20 years ago. The second best time is today. Don't let another year pass wondering what if. Your future self will thank you for taking that first step today.